Welcome to our March 2023 WPS Provider Webinar. With this webinar, we are focusing on the topic of the worksheet S-10 charity care audits. And of course, for 2023 audits, we're dealing with the cost report periods beginning in federal fiscal year 2021. So 10/1/20 through 9/30/2021. That's what we're dealing with this year. Now, for a quick agenda, we'll be going through a little bit of an overview. You'll notice if you've attended a lot of these sessions, these S-10 specific sessions in the past, there's a lot of carryover from year to year. A lot of it's just refresher, repeat information, but there are some changes from time to time, and that's, of course, what we want to focus on. So we'll go through a brief overview and time frames related to this year. I'm very briefly going to be talking about the cost reporting changes that are effective for 10/1/22 fiscal year begins. These came out in Transmittal 18 of the hospital cost report form set. Now, of course, just in the last slide, I mentioned that we're currently doing fiscal year beginnings 10/1/20 through 9/30/21. So what that basically means is these changes won't really become effective for the S-10 audits for 2 more years. So I'm just briefly going to introduce them because, of course, they do impact how you submit your cost reports. They just won't impact our audits quite yet. We'll talk about the cost reporting instructions themselves, again, specific to the audits we're working on. We'll talk about the charity care and financial assistance policy and the importance of items being in that policy. This is something that came up a couple of years ago, and now we're in really the first fiscal years that it should have had a chance to incorporate those things that we talked about 2 years ago. So again, more to come on that. We'll look at the cost reporting templates for the S-10 data. We'll remind everybody about the file exchange, which was previously known as Secure EDI, how to use that mailbox. Then we'll talk about some special points about charity care, payments, and bad debts specifically. And briefly, just a refresher, reminder on the available resources. And of course, throughout, if you have any questions, feel free to post it to the chat area. And then from time to time, I'll take a look at the chat area to see if there are any questions relevant to what we've been talking about. And that way we can address them throughout. Just as a reminder, this session is being recorded, and I'll post it to our WPS YouTube channel, as I have with the past videos. So, overview and time frames. Last year we dealt with the fiscal year 20 audits, and these were cost reports periods beginning 10/1/19 through 9/30/20. Those, of course, had to be completed by December 31st of last year. Now, we don't yet know for sure what that data is going to be used for. We won't know until probably next month or maybe May when the proposed rule comes out. But what we are pretty confident on is that CMS is going to stick to this averaging. Again, it's not a guarantee. They could always propose something else, but it seemed like they were pretty strong on sticking with that averaging rule instead of just using 1 year's cost report to determine and calculate 1 year's factor 3. They're using, for this current year, they used a 2-year average, 18 and 19. We expect that they're going to use 18, 19, and 20 fiscal years for the calculation of this next upcoming factor 3. But again, that's subject to the proposed and then eventually the final rule. That's what we expect might happen. For the current year, we just said we're working on federal fiscal year 21 audits. And we started these on February 17th by sending out the initial letters. And like in the prior years, our final audit work is going to be due December 31st. So we're still doing 100% of the DISH eligible hospitals. And I'll get to that point in a bit. Again, though, we don't know what this is going to be used for. Maybe they'll keep the same trend, and then next year around this time, we'll see that they're going to use 19, 20, and 21 for the next 3-year average. But that's pure speculation. It's a pretty good guess, but we'll have to wait and see. Now, one thing I want to point out, On February 17th, we grabbed a report from our system for all cost reports that had been accepted at that time within these fiscal years, and we took a look to see which ones had DISH, which ones reported DISH on ePart A. Those are the only ones that are subject to the S-10 audits. You have to report DISH on ePart A. Now, this includes sole community hospitals, as we'll see in a bit. But the point I'm trying to make here is that on that date, there were still some fiscal years that we hadn't received cost reports for yet. For example, the July 31st and the August 31st, there were even some June 30ths that maybe had an extension for one reason or another. So if we didn't receive the cost report when we ran the analysis, they wouldn't have been in the first batch. Now we are running another batch at the end of this month, and hopefully most, if not all, of those remaining cost reports will have been received. So if you're in that group, then you'll be getting a letter in a little over a week. Now, the other thing about that, though, even if we haven't received maybe a handful, we'll keep looking at our system throughout the next few weeks after that to see when they submit the cost report, did they indeed report DISH? Now, this is the 4th year that we've been auditing all hospitals that have reported DISH. Now, again, it's all about, did you report DISH on ePart A line 34? It doesn't matter whether you really received a benefit from that DISH, and that really gets to the sole community hospitals, which we'll see in another slide, in the next slide actually. The sole community and Medicare dependent hospitals are still part of this S-10 audit, regardless of any sort of hospital specific payment. Data from multiple cost reports averaged to calculate a factor 3 for that DISH uncompensated care payment. Whereas in the past, it was always well, I shouldn't say always. For the past few years, it's been 1 year calculates 1 year's factor. Now, what this basically means is every audit that we perform, we know is going to impact possibly up to 3 years of factor 3 calculations in the future. So that's one thing to keep in mind. This is the little excerpt from the Federal Register where they talk about that basically. It says, in addition, for fiscal year 24, and subsequent fiscal years, we will calculate factor 3 using a 3-year average. So they're even saying subsequent fiscal years, but again, things could change. And we're looking at the 3 most recent fiscal years for which audited data is available. So this is the point I was making about the DISH eligible hospitals versus DISH reimbursed. This question has come up for a number of years, and this was addressed back in the federal fiscal year 2021 final rule, again, with other years as well, but here's where CMS finally addressed it. The commenter requested clarification whether or not these sole community hospitals could be excluded because so they said they're not eligible for DISH payments, which isn't true. They're eligible for them, but they're just not going to get a benefit for that DISH because their hospital specific rate is already higher. CMS's response was basically, we're still going to be doing them. All hospitals are required to maintain documentation for cost reporting, including S-10. And they also mentioned how, hey, there may still be some uncertainty whether that sole community hospital will indeed be paid based on their hospital specific rate. Maybe things would change, maybe a recalculation would happen. Yes, it's unlikely. Most of the time when the hospital specific rate is above the federal rate, it pretty much stays that way. But again, CMS is essentially saying we're still going to do it. There is definitely always the possibility that the sole community hospital status could change. The road mileage could change because a new hospital opened up or new roads opened up. So there are definitely those types of things that could change. CMS just wants to make sure we're reviewing them all. So that's what we have for that one. What we will say, though, and what CMS has clarified, is that any termed providers, if you've terminated from Medicare, you'll be excluded from the program. Even if you were still fully active during this year that we're auditing, if you just recently termed, like last month, then we exclude it from the audit. Also, those hospitals that have converted to critical access hospital, for this purpose, they're treated almost as if they were termed, and they do not have to undergo the S-10 audit. But the one question we get from time to time is whether or not critical access hospitals even, well, first of all, do they have to fill out the cost report S-10? And second of all, do they need to keep the documentation and submit it at the time of cost report submission? The answer to the first one is technically yes, they do have to complete the worksheet. In fact, if you look at the bottom of worksheet S-10, it does say hospitals and cause are required to complete this worksheet. It's kind of unfortunate. This did matter to critical access hospitals. I guess it's been several years now back with the EHR incentive payments. It no longer really drives any payment for the critical access hospitals unless CMS is planning something in the future. But they're still technically required to complete the worksheet. However, they're not required to submit anything at the time of cost report submission. It's not a factor considered during acceptability solely because of the fact that they are not reporting DISH. A CAW cannot report DISH. So, and of course, we're not going to audit the critical access hospitals either for that same reason. So maybe CMS will change this at some point to pull out the requirement to even complete it, but it's not something that's being reviewed or audited. Now, the next thing I wanted to mention, so, we talked about how a 731 and an 831 provider, by the time we ran that listing, they may not have qualified for DISH, or they may not have submitted the cost report, so we couldn't determine whether they reported DISH and whether or not to include them in the S-10 audit. So we look at those later fiscal year ends, we'll pull a new report, and we actually do it even after this first round. We do it on a monthly basis to see if anybody has changed DISH eligibility status. So what I mean by that is, let's say we had a 331 provider that when we ran the report, they don't show DISH eligibility. They would not be included in our first round of S-10 audits. But let's say in a couple of months, that provider submits an amended cost report, maybe to revise the SSI ratio, maybe to revise the Medicaid days, which they have every right to do certainly within 1 year after the original acceptance. They have the ability to amend to include Medicaid days, and many times that'll bring in DISH eligibility. That provider all of a sudden is now subject to the S-10 audit. Now, let's say in a worst case scenario, this comes in November or December of the year, and we find that provider has submitted an amended cost report, and now they are eligible for DISH. CMS does require us to do an S-10 audit. Now, obviously, that gets a bit tricky when we're that late in the year because we have to really compress it. And if it's something like January after the year ends, we're really in a rush at that point. CMS needs that data. So what I would say is I'd strongly encourage providers to submit that amended cost report for the Medicaid days as soon as possible so we don't run into a time crunch, which hurts both the provider and the auditor, obviously. The more time we have, the more flexibility on both parts, the more flexibility we have for extensions, things like that. So that's what I'll say on the amended time, the time frame, the point there. So a little bit about the factors. I mentioned that factor 3. It's been a term we've used for quite some time, but I want to go back and make sure everybody's on board or aware of what that is. So the uncompensated care payment is the product of 3 factors. Factor 1, which changes every year, it's basically CMS's calculation of 75% of what the original or empirically justified is the term they use, what those DISH payments would have been that year. 75% of it gets carved out for uncompensated care. So that's like the overall national pool. Factor 2 is a reduction factor that is calculated each year due to CMS's expectation that the number of uninsured patients should be decreasing year by year due to the various programs. And then, so basically 1 times 2, factor 1 and 2, that tells us what money is available to pay out hospitals across the nation. Factor 3 is that hospital-specific share of that pool. This is where the S-10 data comes into play. We review the S-10 data, CMS uses it to calculate factor 3s for a future year, and then that's your share of the big pool. From the Federal Register here, you can just see factor 1, and they've done some calculations, but here are the amounts rounded to the billions. Factor 2, I gave you the proposed and the finalized. And when you multiply factor 1 and factor 2, that tells us for fiscal year 23, they have $6.8 billion approximately that is available for uncompensated care payments. And again, factor 3 is your share of it. So that gives us the overview of S-10, why we're reviewing it, what we're reviewing. But now we're going to talk about the S-10 audits and some of the lessons that have been learned over the years that we've been doing them with, especially with 100% of the provider population. And what we have here, first of all, the format of the submitted listings. Now, keep in mind, these templates have been the same for the past few years. We're not changing them for another 2 years. Although I do want to step back just 1 second. Even though we're not focusing very heavily on the changes that are coming into play that we're going to be auditing in 2 years, but that are effective for current cost reports you're submitting, even though we're not focusing on that in this training, we are going to be putting a separate website or a web page on our website with those new templates that just recently came out in Transmittal 18, as well as a brand new YouTube video covering how to fill out those new templates. And by the way, that'll apply for DISH, Medicaid eligible days, Medicare bad debts, the charity care, all of the different templates. That separate YouTube video will cover all of that, as will the web page. So I'm just introducing it in this discussion, but we will have more detail separately. And in some of our later webinars that are not just S-10 specific, we'll talk about those as well there. We've talked about them a little bit, what was proposed before T18, but now it's finalized. So back to the current S-10 audits that we're performing, the format of the submitted listings. So those templates have been standardized, and we have a certain number of data fields that are required. So part of our audit is going through to see if there are missing data elements that would really be needed to perform a proper review. That might be one of the missing items we request. One of the things that's come up in the past is just the size of those resulting files, especially when you're breaking out each claim by revenue code, which is necessary if you have your professional fees, your physician and professional fees commingled with the rest of that claim data, then that revenue code breakout is needed either on that spreadsheet or maybe a separate supplementary spreadsheet. One of the other submission items was with the query logic. This is a phrase that CMS has used since the beginning of these S-10 audits. They expect us to request query logic from providers, but that term, when you read it, and if you were even to do a Google search on query logic, you'd be talking more about like programming scripts, database scripts, which is really not what we're looking for. We're looking more for a narrative explanation of how you searched your systems and how you made sure to exclude professional fees, how you made sure to include only write-offs during this period, things like that. So we've tried to clarify what we meant by query logic, and we even have a a query logic checklist that we've had for a number of years that kind of walks you through what we're looking for. And we'll talk about that a little bit in the presentation as well. Some of the timeline obstacles, we, as a MAC, we have close to 500 hospitals that are DISH eligible that we have to review. Certainly there are some bigger chains, there are some smaller individual providers. Our goal is to get the earliest start possible, which is why we send them out in February. Once we get the, there's been about a month or so since the last S-10 audits. We get most of the fiscal year ends submitted by then. We start round one, and then we follow up very shortly after with a round two. Even though we put a month time frame on the submission, which hopefully is enough, but if you find that it's going to take you a little bit longer, you can certainly work with your auditor to get a little bit of an extension. The goal is that we have, by starting early, we have the flexibility to work with providers, especially based on their fiscal year ends, because we know, well, first of all, wage index impacts every acute care hospital, not only those that provide the report DISH, but every acute care hospital. That comes up later on in the year. We know that depending on what your time frame or what your fiscal year end is, you'll have maybe a busy period for just regular cost report submissions. So we hope that by starting earlier, that gives everybody a little bit of flexibility on what time frame works best for the review. Of course, we have to have this in by 12/31. CMS needs this to use the data for their rulemaking, both proposed and then final. So that's the timeline issue. Another issue that has come up in the past that's maybe even a little bit more important this year, CMS has really stressed this, is that we want to have the cleanest data possible up front, and we want to spend a good chunk of our time on the upfront analysis instead of basically this upfront analysis. Then we can find the pervasive errors that exist, clean up the listing before we start doing sampling. Because once we start the sampling process, then those errors that we find are pretty much stuck in the extrapolation bucket. And it's just a cleaner audit when we can find some of those errors, some of the more obvious errors up front. And again, our query logic is designed to try to help providers submit the cleanest listing possible so fewer errors exist to begin with. So that's really one of the purposes of this training, just to go through some of these things. Another discussion that has come up, and we've brought this up to CMS, to other MACs, there's a concern from providers about sometimes seeing inconsistent sampling among the MACs. What CMS has said, they are not going to mandate a particular sampling methodology or even sample sizes. A lot of that, sample size should depend on the variability of that population. And by variability, we're talking dollar. But also you now all of a sudden have 3 subpopulations to work with and to sample from. So CMS leaves that largely up to the MACs and the auditors, because it is such a judgment call on when you need to stratify something. Is it, they say, for example, inpatient versus outpatient. A lot of times that's just simply small dollar versus large dollar, but it's all about risk. What do we see that is obvious risk within that listing? And if there are different types of risk, we may be stratifying that listing in different ways. Extrapolation. If we are doing a statistically valid sample, CMS does require that we extrapolate those error rates. Now, again, in a perfect world, we'd find all or most of those errors up front. But in reality, there are some errors that might exist in a listing that you cannot you simply cannot find by looking at the listing alone. You have to look at the detailed documentation to find the error, and that's what really is left for extrapolation. Let's see, types of supporting documentation requested. So that largely is going to depend on what the listing looks like and what the query logic says, the query logic checklist says. But the goal is that the same type of documentation will be submitted. A lot of it depends on what your system looks like, of course, and different providers use different systems. Even in the electronic health records environment, there's still different types of systems available. There have been some issues with communication breakdowns in the past, so we really try our best to identify the proper points of contact. We actually have a log that we update every time we carry it over from one year to the next, but then throughout that year, if provider contacts have changed, then we update the log. We just keep carrying it forward. Now, this is above and beyond what we call our STAR system, which is basically the system that we have the usually anywhere from 1 to 3 authorized representatives or officials for that provider. The main information goes out to them, but then we know that most providers have certain people that work with certain issues. So we try to keep an updated record of that, and that's our S-10 log. So certainly if anything changes, let the auditor know, and that way they can update the log so we know who to contact in the future on that issue. Now, some chains have brought up the fact that we have multiple auditors that might be working with that chain. And part of that's just the necessity of the situation. I mean, we can't possibly have one auditor working on a chain that has 20 or 30 providers. That's just not feasible. So we do have quite a few auditors we have to spread this work across, because S-10 is not the only thing they're doing. They also have the desk reviews, the audits. So we do have all of our what we call the field office staff, field audit staff, working on the S-10 audits. Now, that being said, one of the things we've changed this past couple of years is for the bigger chains, we've tried to set up a coordinated entrance and exit conference to try to cut down on the number of meetings that are necessary, the number of times information needs to be transmitted, and hopefully cut down on inconsistency. So that's one thing I'll mention there. And the other issue, insufficient time to review or respond to adjustments. So there should be 2 weeks for the adjustments, 2 weeks by the time we submit them to you before we ask for the time frame back. Now, in some situations early on in the year, we might be able to give a little bit more time if there's a good reason for it. But by the time we get down to December 31st or close to it, again, we have kind of a drop dead date there. So just one thing to keep in mind. But hopefully the fact that we have the right contacts will make it a little easier to hit that 2-week time frame. And there have been questions addressed about education or training opportunities. So CMS themselves has not offered any global kind of national type training, but each MAC, that's pretty much up to them to provide the training. We have every year at the beginning of the cycle, we have our S-10 audits. We have of course, our YouTube videos, recordings of previous S-10 audit webinars. And then we also have other quarterly webinars where we talk about a variety of other topics. Occasionally, S-10 will sneak into those discussions as well. But the goal is to discuss some of the types and frequency of errors being seen, give auditors or give providers a chance to bring questions up that they might have. And before we move into the next slide, I wanted to take a look at the chat area. So Terry, for the slides, I did send them out in the initial email that went out, but I know some people might have been passed on, or they might have received the invite from somebody else. So what I'll do is I'll take a look at the roster, everybody that's attended this, and I send out kind of a post meeting email, if you will, with information on the recording, and I'll also include the slides and the agenda there as well. So you'll get it that way if you haven't already received it. And Natalie, so you have a question about how to review STAR and make changes to the 3 contacts. It's all based on what's in your provider enrollment CMS form 855. Those are the authorized officials that we have, and I think even providers use the PACO system to fill that out. So if you ever need to update your authorized officials, you just need to work with the provider enrollment area and send in a new 855. I'm not sure the exact section of that, the page, but the provider enrollment area would be able to help you out with that. Now, if you need to make a change to just one of the other contacts for S-10 specifically, just a simple email to the assigned auditor would work for that. So hopefully that helps to clarify that. And let's see here, the cost reporting instructions. So this is the little bit of time I'm going to spend on this Transmittal 18 discussion. Although when we show the cost reporting instructions, even though the ones prior to 10.1.18 are still the same basic instructions, they've really done a pretty good job of cleaning up the formatting and making it much easier to understand. So we'll see that in just a bit. The requirement here that was effective, and these are actually two different things here. Transmittal 18 we'll see in just a bit. But the requirement that's effective for 10.1.18 and after fiscal year begins is simply that you must have a listing submitted with your cost report that what the phrase is corresponds to the amount reported on the cost report. This is valid for your DISH Medicaid eligible days, for your Medicare bad debts, for your charity care, and it also involves GME, which really that's been a requirement for much longer anyways. That's with the IRIS. But the point is that that listing has to be submitted at the time of cost report, the initial submission, to avoid rejection. Now, the one thing I want to mention there, the reason I'm bringing it into the S-10 discussion, we've had some questions on whether or not, since the provider already submitted the listing with their initial cost report submission, whether we still need that at the time of S-10 audit. And the answer to that is yes, we still need the S-10 auditor to receive that for a couple of reasons. The first reason, of course, is there's a lot more information required at S-10 audit than was at the time of cost report submission. The second reason is that things may have changed. You may have a revised listing that's now different than the initial listing you submitted, a year and a half or so ago when you submitted the cost report. Or maybe not a year and a half, 6 months ago, 9 months ago, whatever the case may be. So for those reasons, the S-10 auditor still does need to see an updated copy of that. It's basically kind of an attestation that here's what we want you to audit. Here's what we want to report. Now, the changes that I talked about specifically from Transmittal 18, they affect fiscal years beginning on or after 10/1 of 22, which will not impact this year or next year for the S-10 audits because we're doing 20 and 21 respectively. But there were quite a few changes in obviously the design, but also some changes to how S-10 looks itself. First of all, they now have a part 1 and a part 2 for S-10, and really kind of arguably they have, if you want to call it like a part 0 or something, it's an overview. They even have that as well. What I'm calling the part 0, the overview, is basically just that. It's the definitions, an overview of the S-10 worksheet itself. That was always at the top of worksheet S-10, the cost reporting instructions. I'll show you that in just a bit. But then they have part 1, which is what we've always audited. We didn't call it part 1 until now, but this is basically what we've audited. These instructions for all the S-10 lines, all the amounts relate to the entire hospital complex. So the hospital, the psych sub, the rehab sub, all the different subunits or sub-providers, they'd be included as well. There's a new part 2 that is only the hospital. Same basic lines, but it's all of that data that only relates to the hospitals. We don't know yet what CMS is planning to do with that. Maybe in the future, in the future, possibly that's going to be what they use for Factor 3. There have been some discussions in the Federal Register on that. There's also been some pushback. So I think they're just trying to analyze it to see if it's fair and proper to use that data in the future. But again, nothing solid on that. We don't audit Part 2 currently. We're only auditing Part 1, the entire hospital complex. So now I know this is a small slide. It's a lot of information on a small slide. I'm certainly not going to read through it all, but I just wanted to give you a view of what it looks like now, how it's much cleaner than it used to be. For example, this is line 20, cost reporting instructions. Instead of one giant paragraph they used to have where everything was just kind of mushed together, now they have bullet points. So for example, it says, here's what you are reporting, here's what the on or after 10.1.16. So I'll just remind you a few times throughout as we're going through various topics that we want to focus on the on or after. They are quite different instructions in some very important ways. And here's what I was mentioning about the overview. So if you look at, this is from HFS, if you look at the hospital cost reporting instructions, you'll see S-10, but then you'll see a Part 1 and Part 2. If you just click on this S-10, you get all the definitions and the overview. That's what I was kind of referring to as Part 0. And then Part 1 is the what we know of as the S-10, hospital and the complex. So now we are going to start talking about the cost reporting instructions themselves. And we're going to first talk about, we're going to kind of start from the bottom and work our way up. CMS uses to calculate the DSH uncompensated care factor. Now, it's not the very last line of S-10, but it's the second to the last line. It's labeled cost of uncompensated care. I will mention that line 31 is basically, it's line 30 plus some stuff from line 19. But everything from lines 2 through 19 of S-10 are not Medicare applicable. They're possibly used by Medicaid programs, but we do not audit or review lines 2 through 19. CMS does not use it for Medicare purposes. Therefore, line 31 is irrelevant. Line 30 is what CMS focuses on. We don't audit this number directly because it's a flow number. It's a calculated number. But this is what they use for their uncompensated care payment calculations. As you can see in the instructions or in this label, line 30 is basically line 23, which is the cost of charity care, plus line 29, which is essentially the cost of bad debts, both Medicare and non-Medicare. I want to stress that point. The bad debts are both Medicare and non-Medicare. Now we'll go back up to charity care. Line 20 is where the charity care starts, and it's charity care charges and uninsured discounts. They separate those two things out as far as label-wise, but they're included in the same cell. But there is, of course, a breakout between uninsured and insured, and it's a very important breakout. One of the big errors we've seen in the past is that providers have put it in the wrong column or they've used only one column. It's extremely important to separate these out because uninsured charge ratio, it is calculated at 651,000. That's ultimately what is going to be allowed for this column. The uninsured patients, however, that's assumed usually to be a deductible coinsurance or copay amount. It's not charge-based. Therefore, it doesn't need to be subjected to that same cost to charge ratio. So what I'll say is in many cases, what you see in line 2, and you know, I skipped a line earlier. Let me back up. But what you see in line 20, column 2, in many cases, that'll match what's in line 21, column 2. Line 21 is just the cost of that charity care. Now, notice in column 1, our $2 million actually ended up being $684,000 of cost. The line I skipped is a line that's not commonly needed, but it's line 22 related to the payments, which offset that. But what I want to bring up this multiple times because it's another issue that's happened in the past, that's come up in the past. This payment line does not reflect all payments made by that patient. It only reflects payments that they made against something they didn't need to make a payment for because it was written off for charity care. Many of the patients are still going to owe a portion of their bill. Let's say they were approved for 75% charity care. They still owe the other 25%. When they make a payment against that 25%, that's just a regular payment. That is not to be reported here. It's only if they made a payment against that 75% that was charity care that something would be reported here. Now, I'm kind of jumping to another line. We'll see it a little bit later. But the other thing I want to point out here is that a lot of hospitals have brought up the fact that their policies, for whatever reason, whether just provider specific or something statewide, maybe related to their HRSA eligibility, for a variety of reasons, they have policies that require them to refund any patient payment that was made against a charity care write-off. In other words, they'd say, hey, patient, thanks for the payment, but you didn't need to make that payment. We already wrote that account off for charity care. If they refunded it, then that really means that line 22 should be zero all the time. And we do see that quite frequently, that it's not supposed to be a high amount. It would almost seem unusual if it was a high amount. So that offsets the amount of charity care that ultimately flows down. But the point I wanted to make is that insured patients, for the most part, are not subject to the cost to charge ratio. There's one exception to that I'll bring up a little bit later on, and it deals with these line 24 and 25. We'll come back to that in a bit, but let's talk about line 26. This is total bad debts. There's only one column. It's not split by uninsured or insured, and it's really not split. It's not split column-wise. Well, line 26 itself is not split between Medicare and non-Medicare. It's total bad debts. So there are Medicare bad debts in there, but there are also total bad debts or non-Medicare bad debts in there. The other thing to point out is that line 26 should have already been netted of any recoveries. So if you had any recoveries from a prior year, they should have already been netted from this before you reported it in line 26. The other thing that's been a little contentious over the years is that line 26 is supposed to be those bad debts written off on your general ledger or your accounts receivable ledgers, even if they're not yet allowable for Medicare. So even if you have a Medicare patient that's included in this total bad debt, what we want to see is when was it written off on your general ledger, even though you may have had to wait even longer to report it for Medicare purposes due to it being waiting to be returned from the collection agency or whatever. So that's something we've tried to work with CMS to get it clarified a little bit in the instructions. They went part of the way. They really did clean up the bad debt instructions. They didn't quite get where we had hoped, but it is where it is. But either way, they have clarified to us. They've agreed with us that it's the general ledger write-off that determines when something gets reported on line 26. The other thing that I was really hoping they would change this transmittal is the word expense. It's absolutely wrong. It's not an expense we're looking for, it's a write-off. Now in GAAP, using the allowance method for bad debts, the expense happens first, and it's an estimate. We don't know any specific patient that won't pay. It's just an estimate across the board. That's when the expense happens. The write-off is patient specific, and it could happen 120 days or more after the fact. It may be in another year altogether. So I was really hoping they'd change that. They did not. The instructions clearly talk about write-offs, but this is a misnomer there. Now, again, line 26 is total bad debt. Medicare and non-Medicare need to be in this number. And then behind the scenes in the calculation, it needs to know how much of that total bad debt was Medicare and how much was non-Medicare. But the way it does it, which again is kind of faulty for its own reasons, but they take a look at what Medicare bad debts you've reported on E-Part A, E-Part B, all those other reimbursement settlement worksheets. And basically that's how they carve out the portion of line 26 that's non-Medicare. Now again, because of what I just said a bit ago about this being not necessarily reported in the same period for total versus Medicare, due to having to wait for the collection agency, there's a little bit of fault in that logic, but over hopefully a 2-year period, everything washes out. That's the argument. So Medicare bad debts, these are all flow numbers. You can't do anything with 27 through 29. They're all flow numbers. And what it's essentially doing is it's taking both the gross amount of Medicare bad debts, and then the reimbursable Medicare bad debts. So you have that 65% reimbursement there. That's what's happening right here. 27.01 is the allowable. That word is kind of unfortunate in its own, but it's the gross Medicare bad debts. And then 27 is the 65% of that number. Now, the reason that's important, of course, is that if you've already been reimbursed from Medicare, you're not going to get another reimbursement. You're not going to get another benefit for it here on S-10. So it carves out the 65% that you've already been reimbursed. Now that 35% flows down to line 29 along with one other thing. The portion of that total bad debt that's non-Medicare, but multiplied by the cost to charge ratio. And that's another contentious point. Providers have argued that, hey, not all non-Medicare bad debt is a charge. Some of it might be another insurance company that's only deductible or co-insurance. And that's been asked and answered by CMS. As it stands right now, they're still subjecting that to the cost to charge ratio. So let's see. And basically, I've just talked about all of that right here. So that's how the cost report instructions work. Now let's talk more about what needs to be reported. Column 1, we're talking about uninsured charity care charges. Now, as I said, the instructions are much cleaner. This is uninsured, so it should be the total charges or the portion of the total charges for uninsured patients. That's the easiest piece. Total charges portion of the hospital stay. That non-covered portion needs to be in column 1 because it's going to be a charge. And it's going to be subject to the cost to charge ratio. So in that situation, your claim is split. The covered portion is in column 2 as insured, deductibles and co-insurance, but the uninsured portion, the charge portion, is reported in column 1. Now, we also have thing here, they specify this. I'm not really sure why they specify this. They've never given us a good answer, but a charge for a non-covered service provided to patients eligible for Medicaid or another indigent care program if such inclusion is specified in your policy. So this fourth one is very similar to the third one, although of course this might be the entire stay. They're non-covered at all because but they're still eligible for Medicaid. But the key phrase here is that it has to be included in your policy. We'll get to that point in a bit later on as well. We've tried to remind providers over the past couple of years. There have been management letters. We had a website. We had an individual letter that went out to every provider stressing this point. If you want these things to be included on S-10, they have to be included in your policy. And then, oh yeah, this is a good note they've added in. It's been applicable since the beginning, but it clarifies it. So we only want the charges that are charity care approved. So if you qualified your patient for 100% charity care, then yes, it's going to be 100% of the charges. If you only qualified them for 70% of the charity care, then we only want to see the 70% charges here. The other 30%, they're a regular claim. They're not uncompensated unless eventually they turn into a bad debt, which is a different story. But that's the key thing. We only want to see the true charity care portion here. So what we have here is really, this is just kind of a repeat of what I just said. Again, your charity care policy has to specify that. Now, there's one other piece I wanted to talk about. Let me go back. This one, that last bullet point, it talked about Medicaid or other indigent care programs, but it talked about non-covered services just in general, because that would be entirely a charge-based item. The entire stay, in many cases, was non-covered, so it's charge-based. You might actually have a situation, they didn't specify that here, but you might have a situation where they were Medicaid paid and certain of the services were non-covered, but the rest of the stay was. And by certain of the services, I'm talking about just a particular type of service. Nothing to do with what day they were on, but just a particular service just flat out wasn't covered. That would also fall into this group here where that service would be reported in column 1. The other side of that, though, is when a part of that stay is non-covered simply due to the fact that they exceeded a limit, a length of stay limit, called the capitation. And if they exceed that length of stay limit, then that portion, for whatever reason, that needs to be reported along with the rest of that particular claim in column 2. And again, this is where that line 24 and 25 come into play. We'll talk about that in a bit. But this is just an odd thing that CMS has separated out. They haven't explained why, but we'll get back to that in a second. We, of course, only want the portion of the claim written off this period, and it has to be based on your charity care policy. Got a little note about the pre-2016 cost reports, but I don't want to confuse things too much. So it has to be written off during this cost reporting period. It doesn't matter what the service date was. Now, a lot of what is allowed on S-10, CMS reiterates multiple times, is based on your internal charity care policy or financial assistance policy. So unlike things like indigent Medicare bad debts, where CMS has a global standard that must be met, a global policy, if you will, they leave it up to the providers to determine what their charity care policy allows and what it doesn't allow. That being said, there are a couple of things that are hard and fast rules that we can't, no matter what your policy says, they're just not allowable. Courtesy discounts, which are generally for certain groups of patients. A very common one would be clergy, where you give clergy a discount, or the chaplain, whatever, anything like that. Those are courtesy discounts. Employee discounts fall into this as well. Those are not included. Those are not allowable. And then physician or professional services. those are not allowable either. Another type of charity care is the self-pay or uninsured discount. Those are allowable, but your policy has to specify it. Let's see. Here's another thing that's changed or that's been reiterated over the past few years. CMS wants to make sure that if you have a charity care amount and if you've accepted a payment against that charity care amount, which, as we said earlier, is pretty rare because a lot of times it's refunded. But if that happened where you had the charity care and the payment against that charity care amount in the same year, they don't want to see either. They want them both removed from both listings. The only time you should ever have a payment is when the charity care was written off in a prior year and now the patient made a payment against it and you accepted it. So that's an important note there. Again, we're going to see situations where you have both a covered and a non-covered portion of the claim due to exhaustion of benefits, just certain services weren't covered. The non-covered portion is going to be a charged portion, and it has to be reported in column 1 because it's uninsured for that period of time at least. And then the covered or co-insurance deductible copay portion is included in column 2. So of course this gets a little complex, and when we audit it, we'll see the same patient, same dates of service in 2 separate listings, or at least on 2 separate lines. And the first thing that would come up is, is this a duplicate? Why is it here twice? And we need documentation to show why it was split. Of course, it's possibly a very valid split, but we just need that documentation. Again, back to what I said earlier, and we'll hit this another time or two because it's rather complex and unusual. But this treatment that I'm mentioning up here about splitting the bill, it does not include those claims where the reason a portion of that stay was non-covered was solely due to that length of stay limit for Medicaid. That's going to be handled on line 25, but it also needs to be part of column 2 of line 20. Again, I'll get back to that in a bit. Let's see. So column 2, insured. Now we're down here. It looks pretty simple. Most of it's simply going to be a deductible or co-insurance for insured patients that you have a contractual relationship with. But again, there's that odd piece. I know you can barely read it here. It's non-covered charges for days exceeding a length of stay limit for patients covered by Medicaid, if such inclusion is in your policy. And here they've cleaned it up. It says this amount must also be included on line 25. So the same amount needs to be part of what's in column 2, line 20, but separately, just that specific amount needs to be reported on line 25. So line 20, again, for insured patients, I will mention that even though they updated the cost reporting instructions and they added copay into one section, but they left it as co-insurance and deductible in the other sections. Regardless, it's been clarified that we can allow copays. It's just a different version of a co-insurance. That was a little controversial in the very first year of audits, but that's been clarified over the years. And here I have that exact same thing about line 25, which we'll get to in just a bit. I'll show you how it works. Again, this has to be a write-off during this cost reporting period, regardless of when the service date happened. And the same payment rule comes into play only if it's the same year and you accepted the payment, both the payment and the charity care should be removed. Here's just a little slide about where they added co-payment up here in line 20. But then if you look down into some of the details, they just say deductibles and co-insurance. It doesn't matter. We're allowing co-payments. We already talked about how, just like column 1, we cannot include courtesy discounts or physician professional services. Let's see. Oh, yeah, here's the other thing. So with insured patients, now Medicare is certainly a type of insurance. We generally would not expect a Medicare patient to be included really anywhere on line 20, because those are bad debts generally, and Medicare bad debts go on E Part A, E Part B, and then they flow over down to line 27 or 27.01. They're not charity care, even if it's an indigent Medicare bad debt, which is often referred to as charity care bad debt, even before we started auditing charity care. But they are two separate things. Indigent Medicare bad debts, we generally would not expect to see up in column 2 of line 20 or anywhere in line 20. However, there are some situations where you may instead decide to report it as charity care instead of a Medicare bad debt. But we would need to see the documentation or the explanation for this, because obviously it's a very big risk that that same claim may be reported for two separate benefits. So what we would expect to see is some reasoning. Why did you not record it as Medicare bad debt? Why can't you report it as Medicare bad debt? And generally the reason would be you didn't meet one of the requirements for Medicare bad debt, or maybe you cannot bill the Medicaid agency to get the must bill policy. If you have some logic like that or some explanation like that, where it just simply can't be a Medicare bad debt, you wrote it off too soon, you didn't bill timely, that would uh, negate its ability to be reported as Medicare. Then, yes, you can report it as charity care on line 20, column 2. But also at the same time, we would expect your accounting to reflect that. So we'd expect to see it written off as charity care there. Now, before we get into the listing itself, I'm going to take a look at the questions to see what we have here. Let's see. We have a question about if most bad debts are considered patient responsibility, deductibles are co-insurance or copay, even for non-Medicare, why is it being multiplied by the cost to charge ratio? Well, the reason, well, no, the deductibles and co-insurance are not being multiplied by the cost to charge rate. Oh, I'm sorry, bad debts. You're talking bad debts. Yes, your argument is the same argument that was brought up in the Federal Register, and there's a very, very strong argument to be had there. CMS, their basic response was essentially that this has been the way it's been calculated, and to keep the averages, to keep things comparable, they kept the same rule. I absolutely agree that it's not the best explanation, and you have a very strong argument. It's just that's kind of what they've required. So there's no, I certainly can't defend that stance, but that's one of those. It kind of is what it is, and the instructions are pretty clear about that. So nope, Tom, you have a very good point. It's just unfortunate. Unless they change it in the future, that's how we're required to do it. And in fact, it's not even that we're required to do it. It's that that's what the cost report calculation does. Now, there were situations in the past where some providers tried to change the reported amount to kind of get the system to calculate what they thought it should have been. That's a complete circumvention of the rules, and that was certainly a big issue CMS was very concerned with. They want to make sure everybody is abiding by the same rule, the same calculation. So that's the other thing about that. Don't try to, on line 26, don't try to report some manipulated number to end up with the result you think is proper. We do need to tie that back to actual write-offs, not some manipulated write-off number. So good point there. You have a very good point. And let's see. Yeah, there was some information on Pecos and Star. Yeah, change of information. So yeah, that's a good point. That's out of the CMS Form 855. It's a change of information is what it is. So it's not your full 855. It's just a portion of it. And then we have a question about the charity care policy. Some providers have a national policy across different MACs, and they're saying our policy is the only one being noted on a management letter as it's not being explicit to certain items. So the thing about that now, if you're not seeing it for other MACs, that's unfortunate. This issue has been stressed very heavily by CMS across all MACs. We have meetings. We have bi-weekly meetings with other MACs where we bring this up as well. So it's very unfortunate you're not seeing it from other MACs, if that's what you're trying to say. But it is absolutely a requirement. CMS hits us very hard on this. And they did, after we had to bring it up quite a bit at the beginning 2 years ago when they first hit us with QASP findings, quality review findings, they gave us the ability to take a look, unless there were some egregious errors, they gave us the ability to start off with a reminder and a management letter. And like many management letters, that's expected to be incorporated as soon as reasonably possible after that management letter. Since those went out, which I have a slide in just a little bit about that, those went out in September of 2020. So the reasonable expectation is that sometime, within a few months or so after that, providers would have incorporated that into their policy. So what I'm getting at here is that this year, this round of S-10s is where we're going to start to see adjustments for those items if there's no proof that the provider tried to incorporate those changes into the policy. And notice that even with this CMS cost reporting instruction changes that they made, they even added in additional references to that about must be in your policy, must be in your policy. So there's really no good explanation for why providers don't have it in their policy now. The reminders have been everywhere for at least 2 years, and they've been in the instructions since the beginning. So I guess the fact that other MACs might not be pointing this out is kind of moot. It's very clearly put out in the policy or in the cost reporting instructions. And again, CMS has issued quality findings against us on this, and certainly other MACs as well. I don't know why they're not issuing you management recommendation letters, but they should be. Let's put it that way. So let's see here. Oh, yes, good point. The T18. So that whole line 25, which actually, let me come back to that question when I get to line 25, and then I'll talk about both of them there. And let's see. So payments. I've talked quite a bit about these payments at this point, and I will bring up the pre-2016 here just to make a point. When these instructions first came out, up until 2016, what CMS basically said was on line 20, they wanted the entire charge, or they wanted the entire claim, regardless of how much was approved for Medicare or for charity care. And then what they did was on line 22, they wanted every dollar of any patient payment to offset that line 20 amount. And that was a lot of extra work, first of all, and it just didn't really get to the heart of what was approved for charity care. So effective with 2016, they now said line 20 is only the charity care approved amount, and therefore line 22 is only payments made against that charity care amount, which again, they don't really happen all that often. And even when they do happen, a lot of providers have policies to return them. So line 22 is never expected to be a very big amount. There's still a listing for it if you do have anything to report. And yes, indeed, if you did accept a payment against a charity care amount, absolutely it's required to be here. But line 22, they just get into all the details with that. So let's see. Again, if it's paid in the same year as the write-off, remove that amount anyways. And it's the payments made during that year, cash basis. And of course, we want to match them in the proper column. So if it's uninsured or insured, they need to be in the proper column there. If the original claim from a previous year was insured or uninsured, it needs to be in the proper column. So here's a little bit of an explanation. If a patient had a $1,000 charge in a 2020 cost report and 75% was approved for charity care, then the patient only owes $250. If they pay up to that $250 amount, that's their that's their liability. That's not something that should be reported in line 22. It has nothing to do with the charity care approved amount. But if they paid $850 instead of $250, then first of all, if they paid it in 2020, which is the same year as the charge, then the first thing we want to do is reduce line 20 by $600. That's the extra $600 of this payment. Again, the $250 is a valid payment against a liability. It's not going to show up anywhere anyways. But the extra $600, since it related to a claim for that same year, reduce line 20 by $600 and exclude that entire payment from line 22. Now, in this case, in that situation, only $150 of charity care ends up being on line 20, and there's no payment reported. But let's move to the next year, 2021. They pay another $150, which is now in a different year. There's no adjustment to charges needed in either of those years, but this $150 payment would indeed be a valid payment on line 22 because it relates to a non-patient liability that was already written off for charity care and it was written off in a prior year. So yes, now this payment comes into play. Again, assuming you weren't required to refund that payment back to the patient. Oh, I skipped over the template itself. Let's take a look at that first of all. Now, again, these templates are changing in 2022. So for this year, we need to know if it's uninsured or insured. We need to know who the payers are, primary and secondary. We need some sort of transaction code to identify, this is from your system. We also need a legend for it, but we need to identify, was this truly charity care or was it uninsured discount? Was it something else? We need to be able to identify that. We need some sort of patient identifier. Now notice there's a name, a birth date, social security number, and even a gender as well as that. Those have been changed in the new templates. For now, we certainly would need the identification number and a patient name. We basically need something to be able to look up the documentation to make sure, yes, that's that person as opposed to somebody else. Arguably, gender really doesn't have any relevance to an S-10 charity care charge. I don't know why it was ever there. Social security number, that was because we might need more information about that claim to basically to look it up, to look for duplicates. But a patient identification number can generally do the same thing. We need the admit and discharge date, of course. We need to know if it's inpatient or outpatient, which I guess you can largely tell that by the admit and discharge date. And we need the revenue code, but really only if you have professional and physician charges commingled into one claim, then we need to have each claim broken out by revenue code. And the reason for that is that we'd be looking to find those professional services and exclude them. That's the reason for the revenue code. If you do not have those commingled, if they're in a completely separate system, then there's no reason for a revenue code breakout and your listing gets much shorter. We need to see the total charges for that claim. This is really what starts the calculation. Kind of right in the middle here, we have the date of write-off. Later, in the newer version, this is moved away from the amounts. But then from the total charges, we start identifying the different pieces or components of those total charges. So some of it might be total patient payments. Now, by the way, this is the entire patient payment. We're not talking about just the payment against charity care. We're saying if you had a bill of $10,000 in charges, how much did the patient pay? Because that means there's less that's uncompensated. So carve out the patient payments, carve out any third-party payments, carve out any patient charity contractual amount, which is really what we're mainly concerned with here. the charity care contractual amount, and then you might have some other items. The other contractual amount, the insurance write-off, courtesy discount. For some other reason, this is not allowed. But column R is the charity care we're looking for. Column T is where we bring in that special situation where you have the exceeding length of stay limit for patients covered by Medicaid. We need to have that number separately reported because it goes in a separate line, line 25. We talked about the payments already. And now we'll talk about this line 24 and 25 a little bit more. So what happens here, CMS, they know that any charge-based item needs to be offset or needs to be reduced by the charity care, by the cost charge ratio, needs to be subjected to it. So they could have done the same thing that we talked about earlier and just split the claim into two pieces, the covered portion versus the non-covered portion. For whatever reason, when these cost reporting instructions first came out, they wanted to specify this Medicaid length of stay limit, and they built in this little mechanism, which kind of, it's clunky. You know, the whole splitting the claim is much more streamlined, but for whatever reason, they did it this way, and they basically said, okay, since it's a Medicaid patient and therefore it's insured, go ahead and report the full thing in the insured column. And what that means is part of that claim would be deductibles, well, whatever term you want to use, deductibles, copay, cost sharing, basically. Part of that column 2 amount would be cost sharing amounts, but the other part that's beyond the length of stay limit, it would be a charge. So that's the odd situation where line 20, column 2 has some charges included in it. We said normally it shouldn't, but here's one example where it will. Now, for the cost report to work right, because normally it does not multiply that by any cost to charge ratio, they built in this line 25 to tell the system how much of line 2 or line 20 column 2 is a charge-based item. So this $12,548 should be part of this $385,000. And this tells the system how much to multiply by the cost to charge ratio. So line 21 of column 2, I said normally that's going to be the same number, or line 20 and 21, except in those situations where you have something down here. And then this little portion of it is going to be multiplied by the cost to charge ratio and then added to the rest of line 20 that was not this 12,548. So that's why you see just a slight difference between these two numbers. Now, again, it's an odd situation. We actually tried to get them to completely eliminate line 24 and 25 and instead just do the split bill situation. And as Angelo mentioned, unfortunately, they went the exact opposite way. And they said, let's do another line 25. We'll call this one line 25.01. And we'll do another situation for exhausted benefit situations where you'll do the same thing. You'll put it in insured patients, but then you'll have line 25.01 that tells the system how much to subject to the cost charge ratio. Again, that's T18. That's for future years. So we'll be discussing that in the later YouTube videos. But I just wanted to point out what this mechanism is for. The end result is the exact same if you were just to split the claim, but for whatever reason, CMS wants to see that number separately. They've never been able to answer, why they need it. Are they doing anything with that number? They've never had an answer for that, but we'll go with what the instructions say. And yeah, and of course, 24 is just a yes or no question. Do you have anything to report here? Which actually this one is an odd situation. This should have said yes. If we were to put that through, it probably would have given us an edit. This was just a bad illustration. That should say yes. And then we talked about the other split claim situation. already covered all of that. But before I get onto there, let's go back to the questions and see what the other questions are. So yeah, we already talked about Angelo's question about the line 25.01. If the patient responsibility is subject to financial assistance screening, isn't it a moot point whether or not the patient had insurance coverage or not? No, because the patient, we need to know whether they had insurance or not, because that tells us whether that patient responsibility was deductible coinsurance or whether it was charge. Because if you have no insurance whatsoever, then your responsibility is a charge amount and needs to be reduced down to cost. But if you had insurance, then your responsibility is a deductible or coinsurance, which arguably was already reduced by whatever your coverage was. So it wouldn't make sense there to reduce it again by the cost to charge ratio. Again, that same explanation can go right back up to the bad debt discussion earlier, but CMS has those instructions that they've put in. But for charity care charges, yeah, the difference between insured and uninsured is important. So let's go into bad debts. I've stressed a lot about this already, but it includes both Medicare and non-Medicare bad debts. They both have to be net of recoveries. There's only one column, and it's a write-off during this period. That's never changed. That's the one thing that's always been write-off during the period, as opposed to service dates. Recoveries should have already been written off. We talked about that. Or they should have been netted out of line 26. Again, do not include physician or professional services. Now, here is one thing that happens that we've seen quite a bit, or not quite a bit, but a few times. Part of our audit is looking for duplicates, not just within this year, but also within the past few years, especially if this service date was 3 years ago, for example. Then it raises the question, was this thing already written off as something else maybe 2 years ago or whatever? So when you have really old claims, that obviously increases the risk, and we might be looking at prior listings to see where it might have been written off. So you can't write an item off as charity care. Let me mention, we're talking about bad debts here, line 26. So you can't include an item as a bad debt if it was also written off as charity care in a prior year or even that same year, unless there's a situation where the charity care was validly reversed. For whatever reason, it was a valid reversal. And what would happen then is we would expect to see the reversal of the charity care and the write-off of the bad debt in the same period. Again, that should be fairly limited, and it should be a valid reversal where you uncovered more information and they really didn't qualify for charity care, whatever the situation might be. And it could go vice versa. It could go the reverse way as well. But there has to be documentation showing why it was written off erroneously the first time. Now, the bad debts, another part of our audit is we're trying to reconcile to some other documentation you might have, like trial balance or financial statements. Now, the total bad debt is a write-off, as we said earlier. Regardless of what's in the label, it's a write-off, not an expense. What's on your financial statement and your working trial balance is an expense. There's not a write-off line of the income statement unless you're one of those very rare facilities that would use the direct write-off method, which for a hospital, I can't imagine that happening because bad debts are generally material. So we are trying to reconcile a write-off number to an expense number, and by their nature, they're different things. So we need some sort of reconciliation, and there are a variety of ways this could be developed. These are well, I guess I just included one example, but this is a very basic example that you can walk through. It's a 2-step example to back into what your write-offs must be. using your ending accounts receivables, how they've changed throughout the 2 years. But again, you could have different versions of this. We just threw this in as an example. As you can see, it's been around for a few years. But what we don't want to see is we don't want to see just, hey, we're reporting $1 million of bad debts, and hey, look, it ties exactly to our income statement, the bad debt expense line. That would not be valid. It would be extremely coincidental for those two numbers to be the exact same, just extremely unlikely. Here we get our bad debt listing, which is largely the same as the charity care listing. Most of the elements are the same. If you get down here, we have the total charges, and now it's a date of write-off to bad debt. And then we're backing out basically those same things: patient payments, third-party payments. But here's the piece I want to stress here. We have patient charity contractual amount. This is not necessarily going to be the same as what was on our charity care listing. This is the history of this entire claim. How much was ever written off for charity care for this one claim? Because that means that's less that's left for bad debt. We're trying to back into what the allowable bad debt should be. All these other carve-outs, and then whatever residual amount is left is reasonably a bad debt. Now, the other thing I want to point out, though, on the charity care listing, I skipped over this. We had this same other contractual amount column. Bad debts could have been there for that charity care listing for the same reason, to back into what's left for charity care. Now we're trying to back into what's left for bad debt. In the new template, this was expanded a little bit more. There's a little more clarity to it, but it's all the same purpose. We're trying to back in to whatever should be on this listing. And we're trying to explain away where the rest of the charges went, essentially. Now, the other thing, and again, there are only certain things of what we audit, some general things that I can touch on. One of them is we're looking to see if these components exceed the total charges. Because if you have $1,000 of total charges, and then you have, 500 patient payments, 400 third-party payments, and all of a sudden like 300 or 400 or 500 bad debt or charity care, that makes no sense. You can't have all of those components if you only have $1,000 in charges. So that's the other purpose for reporting these that way. Now here's the point that I've talked about a few times already about the charity care and financial assistance policy. And it gets in, as my little illustration shows, policy versus procedure. In other words, what are you actually doing versus what's in your policy? CMS has made it clear that they expect there to be a good internal control in your policy delineating what you're supposed to be doing, or what you approve, what you allow. And that's obviously approved by your board or whoever approves that. And that should set the stage. If you see procedures acting outside, in other words, actual practice, let me put it that way, that varies from the policy, that's where they have a concern. We're being lenient, so have your policy clearly stating what you allow and what you don't allow. This is, again, part of our required audit steps. After we got that first quality finding, and after we had our very first meetings with CMS, where they came down pretty hard about this in September of 2020, we sent out reminder letters to every single provider, which is something we normally don't do for things like this. We normally put it on our website or whatever, but because of how hard they came down and how very clear they made it that they want this in policy, we sent individual reminder letters. We also put it on our website. We also put a YouTube video out there. We also do management letters along the way. So you can see just how important this issue is to CMS. And again, this was 9/18 of 2020. We're currently dealing with fiscal year begins on or after 10/1 of 2020. Now, yes, that was only not, it was 12 days. So if it's a 9/30/20 provider that started 10/1/20, we're not going to expect that within 2 weeks they made a change, but we're probably going to be asking questions, can you document when you made the change? Did you even address the reminder letter or the notification? For later fiscal year ends that had plenty of time to adopt it, you may be seeing adjustments this year for that reason. Things that aren't allowed in your policy and the cost report instruction requires them to be, there might be adjustments made. The other thing about this, not maybe as important, but the policy should be titled clearly charity care, financial assistance. CMS has kind of hit us on that in the past. There were some subsidiary type policy, if you will, that maybe supported a charity care, but it was something completely separate. They want it to be in these policies. So that's what I want to mention there. Now moving on to the cost report templates. We've already talked about the templates themselves. This is a link to where you can find them, but they're also out on our our WPS website. The query logic questionnaire is something I wanted to spend some time on, but what I want to do is I'm going to skip this piece for now. I'm going to go through some of the remaining slides, and then we'll go through the query logic questionnaire. A little bit of information about the File Exchange, which is our secure portal where you can send in information. Through regular email, you don't want to submit PHI or PII, but through the File Exchange, it's a secure file transfer portal, and it's based on a standard maybe tool. File Exchange. Now, it used to be called Security EDI. It's the same basic design, except it's a new website, and the color scheme is a little bit different. But here's the important thing about this. The way the security is in this system, in order for you, providers have what are known as temporary accounts. And in order for you to be able to contact an auditor, they have to be in your email address and in your email address book, The way that address book gets created is basically by then sending you the first kind of invitation type email. They establish the connection, and then you can go back and forth. But it's auditor specific. So for example, if I was to send you an email, but your auditor is someone else, you would only be able to communicate with me. You'd never be able to communicate with that auditor until they finally sent you their own invitation or initiation. So you definitely want to have your provider or your auditor reach out to you so you can establish that link. Now, if it's the very first time you've used Secure EDI or File Exchange, or if it's just been a while, then their initiation email will also give you the initial password to use, because they do expire rather quickly, unfortunately. Now, if you need to send information to multiple providers, each one is going to have to send you that initiation email, although, of course, you won't have to keep getting new passwords if you already have an active account. So here is the link to that. And you know what? I'm sorry, this should be WPS GHA. The old one was secureedi.wpsic. This should be fe.wpsgha. It has much larger size limits, whereas with email, you're lucky to get 20, 25 megabytes. Here you can have up to 2 gigabytes. Unlike the old portal that we had a few years back, there are no file type restrictions. It is secured, so you don't need a password, but if you feel better putting the password there, you can too. It's easier when we see it. We still see the file name. And one of the big benefits is that we can use this tool with non-provider representatives. In other words, home office staff, consultants. That was not allowed in the tool we used a few years back. If you want to zip files into one, you certainly can. It's not required. It does make it easier when we download it, of course. And here is information about the expiration. They're active for 20 days, and if you don't use it within 20 days, it expires. Again, it's pretty easy to have it reset up again. You got to get with that auditor, but if you log in 20 days, it'll keep active. You can also contact your auditor for password resets. So that's really the information we have for the Secure EDI tool. And let's see, duplication of claims on listings. So I mentioned earlier that one of our audit steps is that we have to look for duplicates. That same patient and identification number, we look to see if it existed in another claim, another listing. It could be the same year, just two different listings, or even the same listing, two different lines, or it might be current versus some prior year. Now, we look for those and we determine if they're so for example, 2020, you wrote half the claim off for charity care. You determined right away that they qualified for charity care. That half is gone, but then you're still trying to collect against the patient for the other half. And then you wait, a few months, maybe it gets into the next year, and you realize you're not going to be able to collect. So now all of a sudden that portion becomes a bad debt. They're both valid, assuming that the sum of all the components, in other words, charity care charges, bad debt, payments, contractual, assuming those don't exceed the total charges for the entire claim. So that's kind of what we're looking for in that situation. If we do see what at first appears to be a duplicate, we look to see if there's a reason. Maybe it's just two different parts of the claim. Sampling, which I know we have a question about the sampling here, so I'll get to that one in just a second as well. But with sampling here, as I said earlier, when we have a statistically valid method, we are required to extrapolate those error rates. And what we do when we're determining the sample size, first of all, we look for, based on the variability of that listing, we plug it into our system to determine what our minimum required sample size is. But that number can change after we make our adjustments. We have to plug it back in to validate that sample. And depending on what adjustments were made, what errors we found, let's say we found first that 30 was the sample size. If we made certain errors, or if we found certain errors, now all of a sudden the system may spit out and say, well, hey, 35 is now the minimum sample size to be representative. So to avoid us having to do a second request, we generally request a few extra spares, not some crazy number, but just a few. Sometimes it's 5, but there's still a possibility we may have to come back for a second request depending on what the system spits back. And it all depends on the new variability of the adjusted listing. So as I said before, the real goal of the audit process is to get the cleanest listing possible up front, so we can avoid quite a bit of that extrapolation. We try to find all the obvious errors. For example, professional fees, claims written outside of this cost period, written off outside of this cost reporting period, situations where there are obvious duplicates. We try to find those first and carve them out so that then we can only sample the remaining amount. I think we've talked about the charity care, the whole splitting. We've talked quite a bit about that, so don't need to worry about that too much. And we've also touched on the fact that the bad debt listing for line 26 should be an accounts receivable write-off rather than, if it's a Medicare patient, rather than when you recorded it as Medicare bad debt. Again, the example there is that you reported it, I don't know, November of 2020 it was a write-off against your accounts receivable, but then you sent it to the collection agency and you waited maybe 6 months, 9 months, a year, it was finally returned and you could finally report it for Medicare, that's going to be in a different cost reporting period. That situation can happen. Line 26 is all about gap-based write-off, whereas Medicare, E-Part A, E-Part B, of course, that's about Medicare policies for write-off. So payments, again, we hit on payments quite a bit. HRSA is an issue that obviously is becoming less and less important for this payment because they're running out of funds anyways. But CMS did require us to look at this, and depending on the year that you're dealing with, we might still need to be looking at this. Basically, if you have a claim that was where the patient or the claim part of it was paid for this HRSA uninsured provider relief fund payment, then that payment, even if it's only a portion of what the claim amount would have been, that's considered payment in full for that type of service. In fact, you had to agree to that to accept those funds in the first place. So this could impact both charity care and bad debts. So we might be looking for that depending on the year. It's getting less and less likely as time goes by because, again, that HRSA fund ran out of funds. It didn't really have much money toward the end. I'll talk about this briefly, then I'm going to go back to some of our earlier things and to the questions. So these are just the available resources. We have our overall website, which this one actually takes you to the guides and resources. In other words, the entire audit section. And then you'll see our entire listing of topics, S-10 being one of them. Here's just one of our YouTube, or actually this is our YouTube channel. So this takes you to the entire playlist for the audit YouTube videos, which include, and actually 2 is wrong now, we have multiple prior S-10 training courses. We'll add one more after this. This is the link to our templates, and then the initial request letter. Was where we leave off. We left off, the query logic questionnaire. Before I get to that though, let's look at the questions to see what we have here. Extrapolation bucket. So I mentioned an extrapolation bucket in prior years audits. In prior years, audit errors were not extrapolated, just adjusted off. So that largely depends on the scope of that particular audit and the size, what types of errors were found. If it was not a statistically valid audit, then we absolutely cannot extrapolate. So again, a lot of that just depends on how the auditor scoped that based on the risk they found and things like that. But if it was statistically sampled because it was heavily scoped for whatever reason, then that would have been extrapolated. Let's see. We've experienced auditors doing cost report has already been finalized. Cost report desk reviews. So the S-10 audit is in virtually every situation is done before we even get to the desk review. So if I'm reading your question right, the desk review is pretty much always, let's see, for fiscal years after years where our S-10 has already been finalized. Oh, wait a sec. You're saying we've done an S-10 review after the cost report has already, the S-10's already been finalized. So I guess maybe just to clarify, S-10 is going to be done. We HCRAS the data, and then the cost report, desk review, and audit comes in later. Now, they generally wouldn't be doing another review of S-10 unless something very odd happened to have come up, but they generally wouldn't be. So hopefully I'm getting your question right, but if I'm misunderstanding, you can chat it and I'll see it in just a second here. For the bad debt reconciliation, some providers are stating they do not use the income statement approach to record bad debts. The providers indicate that they use the balance sheet approach, which estimates a reserve based on total outstanding. Oh, yes. So actually what I'll say there is what method they use, whether you use the percentage of sales method or the percentage of accounts receivable method, no matter which way you get, you still end up with the allowance for doubtful accounts or the provision for bad debts, whatever you want to call it. So those two methods you're mentioning are just different ways of getting to that allowance. But on the balance sheet, you're still going to be reporting accounts receivables less the provision for bad debts. That gives you your net realizable value of the bad debts. So whichever way you use is fine. Now the reconciliation, again, that all takes your ending accounts receivables, and you look at the change between the beginning and the ending, and you say there are a few things that can cause that change. One of them is that you have new services, therefore new accounts receivables. That adds to it. If you have write-offs, that would obviously reduce it, and there might be some other adjustments in there, but those are the two main. Payments. Payments, of course, would reduce accounts receivables as well. But those two changes allow you to back in to the third item there. So hopefully that helps clarify that. But that really shouldn't be a reason that your bad debts wouldn't reconcile the financial statements. However, what I do want to mention is from a bad debt perspective, GAAP has changed in recent years where, we used to count this as a bad debt expense. And really, it's no longer bad debt expense for most facilities now, most entities. Instead, it's a contra revenue that they refer to as an implicit price concession. So instead of seeing it in the expense line, later on in the income statement, now it's up right by revenues, or you even net it out. You don't even see it in a separate line item, but it's a contra revenue. It's an immediate revenue offset. But again, that's separate from this discussion here. That's just where you'd find it on the balance sheet. No matter which method you use, the old GAAP method or the new GAAP method, you still have accounts receivable. You still have some sort of allowance for bad debts, provision for bad debts, whatever you call it. So that part doesn't change. Let's see. You've just filed the fiscal year 22 cost report on an extension, and you haven't had enough time to enhance the reports as suggested. I'm assuming you're talking about the charity care, or maybe just some other issues that came up for your listing, and you haven't had time to do a second pass review. So if you think you're needing more time to do that, and you might be able to work with your auditor and say you'll have a revised listing in the near future on that. But again, we're fairly limited on our time, so you have to be cautious of that as well. But that might be, now if you're talking about the charity care, again, part of that's going to depend on what fiscal year end you have. And if you have at least proof that you have changed it, it may just not have hit this cost reporting period. So hopefully I'm answering that question good enough. But again, work with your auditor might be the best answer for that. Regarding transmittal 18, what criteria will be used to determine whether a service is considered medically necessary for charity care and bad debt? So that's a good point. That's actually, that rule has kind of been implied all along, but we don't really expect there to be many situations where something would be carved out of that. Now, as far as what criteria, that same question came up even with, I think, might have been the HRSA review itself. I'm thinking that came up, the whole medical necessity. So yeah, if it was denied, if we have obvious proof that it was denied by somebody else as being not medically necessary, then yeah, that would be a good assumption that at least that service, that portion of the claim, wouldn't be allowed as charity care either. There's no other criteria that we're aware of at this point. They haven't told us that we have to incorporate a separate medical review for that. Again, that could change. We're still 2 years out from that, but the limited information we have right now would support what you said about the third party. Because, by their nature, they're already going to have to do a medical review, whether it's Medicare, whether it's an insurance company, whoever. They do a medical review either on a sample basis or whatever. And we would definitely piggyback off of that to some extent. Oh, I see. So Christine, thanks for your clarification. So they're looking at Medicare bad debt that was already included on line 26 as final audited. Yes, you're exactly right. If we're adjusting Medicare, because keep in mind during the charity care or during the S-10 review, we're not looking for all those same Medicare bad debt policies that would be looked at during the time of desk review or audit. We're looking for a proper write-off. We're looking for, I guess not dates of service, proper write-off and proper documentation. But there are additional requirements that would come into play for the desk review or audit. So they certainly could be making adjustments, possibly adding or subtracting during the desk review. And that number by its nature flows over to S10, line 27 and 27.01. Now, depending on the situation, and what I mean by that is that line 26 in no case can be less than your Medicare bad debts, because the assumption, I mean, that makes sense. If total is Medicare plus non-Medicare, then you can't have total being less than Medicare. It just logically doesn't make sense. So there have been some situations where Medicare bad debts might have been reduced so far due to lack of documentation or whatever, that now all of a sudden or no, I'm sorry, that would have to be the other way, where they were increased, where Medicare bad debts were increased, and now all of a sudden they're above total. In that situation, we have to adjust total to that higher number. We can't hickrus the cost report. We can't settle the cost report with that level one edit that we get. So we would indeed have to make that adjustment to line 26. But if it was a downward adjustment, if we were just adjusting Medicare bad debts down, we wouldn't necessarily be adjusting line 26, because, just because we reduce Medicare doesn't mean that total itself needed to be reduced. Maybe the rest of those bad debts were charity. Now, that being said, it does still flow over to line 27 and 27.01 automatically. There's nothing we can do to stop that. So the final number, the line 30 that goes to CMS, yes, that definitely does change. Now, whether they use that new number for uncompensated care largely depends on the timing. Especially now that we're using one given cost report for 3 years of S-10 audit, or 3 years of uncompensated care factors, that line 30, the old line 30 might have been used for one of those factors, and now the revised line 30 after the desk review or audit might be used for the later 2 years of averaging. That situation could certainly happen. So they're using the best data available at the time that they calculate the factor 3. So hopefully that helps to clarify that. And Donna, you make a good point there, and that's kind of the logical issue with the way that CMS has line 27 and 27.01 automatically flowing over to S10. It does create those situations where that could be the case. Unfortunately, because they have a hard edit, we absolutely have to adjust line 26 up to that, to at least equal Medicare, because it just won't go through without it. They have a hard edit. We can't even settle it with that edit. So you bring up a very good point, and you're exactly right. But we have to make that adjustment, unfortunately. We hope they will change that to make it a little bit more, more logical, really, in the future. But they did not do it in Transmittal 18, unfortunately. Oh, so now, we don't have nearly as much time as I thought we would. But let me open up. I just wanted to point out a few things on the Query Logic questionnaire. Again, it's the same questionnaire from the past, but I guess what I'll point out is that we have it broken down by section, and a lot of this stuff repeats. How did you generate your listing to make sure you're only including charity care written off this period? How'd you ensure there were no duplicates? We need a legend of your transaction codes. The whole risk of Medicare bad debts being reported as charity care. Do you have any, and why? The whole exhausted benefit situation versus non-covered service. We detail that here. The whole, what does your charity care policy discuss? The length of stay limit for Medicaid, self-pay discount. Now notice in some of these cases, we're asking for the section of the policy that allows this. Again, it's perfectly fine if your policy allows it, self-pay discount, but if it doesn't, then we cannot include it. How did you carve out physician or professional services? This line 12 is that whole, your components cannot exceed your total. Do you have any situations where that's the case? And if so, explain. Or no, I'm sorry. This is where your components were less than the total. Maybe there was something that didn't fit into one of those columns, therefore you left it out, and now your components are less than your total charges. We're just looking for maybe an explanation why that might happen in your facility. Let's see, presumptive eligibility. If you have it in your policy, it's fine for charity care, even though it's never fine for indigent Medicare bad debt. It's not allowable for that, but it is allowable for charity care. Just a little bit on payments. We've covered quite a bit of that before. And then the whole bad debts. A lot of these are repeat type questions. Written off in the proper period. Here's that whole discussion of, are there Medicare bad debts in line 26 that are also claimed in a different cost reporting period for Medicare? That's the issue we just now got done discussing. We're not asking you to detail every single one. We just want to know if that situation has happened in your listing so we know how to look for it. Some more duplicates, transaction codes, and here's your reconciliation. And again, this is just one general example. If you have another way that's a reasonable reconciliation, you can show us that. But again, we absolutely expect that line 26 is not going to tie to your financial statement. So if it does, that's a very unusual situation and we'd want to know why. We just want this other type of reconciliation. And here we have our HRSA COVID question. And number 24, if you did amend your listing, so we want to know, what's changed. Why have the amounts changed? Why didn't you know about that at the time of cost report submission? This just explains to us that, it's going to be different than what was initially on there. So we're starting off right off the bat with an adjustment to add that in or subtract it, whatever. And then number 25 is a catch-all. Are there any other explanations that you think might be helpful? So I know that was 2 straight hours. We still have a few minutes left for any questions, but any questions on anything we've talked about for S-10 or any of the issues that might help you as we start our S-10 audits? Okay, well, like I said, this session has been recorded, so I will be posting it out to our YouTube channel, and I'll send a follow-up email with the PowerPoints, the agenda, a link to the YouTube after it's been loaded there. And then I'll also send out, it'll be BCC'd, so not everybody will see who's on the listing, but I'll send out a general CET or CPE certificate for the course now that we're not using the Learning Center anymore. So you'll be able to use that for whatever purposes you have. But thank you very much for all your time today. I hope this has been helpful, and I look forward to talking to you in our next session. Have a good one.